Good evening, ladies and gentlemen. Good evening. My name is Ian Whittaker. I'm the Director of Strategic Content here at the Chicago Council on Global Affairs. Welcome, everyone. This is a members-only program, so we'd like to thank all of you for being here and supporting the Council. You make everything that we do possible. We have several young professional ambassadors here tonight. If you'd like to learn more about the young professionals network at the Council, please talk to them at the back. They're at the table by the screen up there. Before we begin, please note we are on the record this evening. We're live streaming. We always welcome your social media engagement, but please just silence your phones before we begin. The Council is an independent and non-partisan platform. Views expressed by individuals we host are their own and do not represent institutional positions or views of the Council. Later, we'll be taking audience questions from in the room, so you can raise your hand old school style, or we'll be using our browser-launched application. You can go to chi.cnf.io. Just put that into your browser. You can ask a question, or you can vote on other people's questions. But for now, please join me welcoming our panel. We have Sheila Bair. She's a speaker and writer. She's the former president of Washington College and the former chair of the FDIC. Secretary Paulson is the founder and chairman of the Paulson Institute and former US Secretary of the Treasury. And moderating this conversation is David Weston. He's the anchor of Bloomberg Markets Balance of Power and co-anchor of Bloomberg Daybreak Americas. So please join me in welcoming our panel.
Thank you very much. That's perfect, so I don't have to introduce people. That's just what I like. Welcome. It's great to have you all here, and particularly thanks to Hank and to Sheila for spending your time. So the subject tonight, as you know, is financial crisis 10 years after. I mean, what happened then, but also what have we learned since then? Where do we stand now? And that's what we're going to try to really focus on. So, Sheila, I'll start with you. Looking at where we are today as opposed to where we were 10, 11 years ago, what is stronger, what is better, and what is maybe not as good?
Right. Well, so the financial system is stronger. It's more resilient. We have more capital. So financial institutions many of them were relying too much on borrowed money, so we've increased the amount of funding they have to have from equity, which makes their funding much more stable. We have better consumer protections. You know, the lack of a consumer agency that had ability to repay standards for mortgages was a key problem, so we have that now. We have the VOCA rule, which is a good constraint on speculative risk-taking by financial institutions that are in the safety net. And we have something called Title II in Dodd-Frank, which I was very personally involved in, which would give tools to the government that Hank and others did not have during the crisis to be able to resolve in a bankruptcy-like process a large financial institution. We did not have those tools. We had them for insured banks, but we didn't have a lot of this activity was going on in investment banks or derivatives affiliates that were outside insured banks, and just the tools weren't there to deal with them. So I think those are all important and make the financial system much more resilient. And whether it's enough, I don't know. I hope it is.
Are there any ways in which we're worse off, do you think?
Well, I think there's a lot of debt out in the economy. I mean, I think we did, the Fed used the tools that were available to it. We didn't have a lot going on the fiscal stimulus side, so they, doubled down on interest rates, zeroed down on interest rates, I should say, and we've kept them there for quite some time, and that's created some distortions. But one thing it has done is encourage more borrowing because it's very cheap to borrow, so we kind of used debt to recover from a recession that was caused by too much debt. So how that's going to all work out in the end, I'm not sure. I guess we're still going to have to find that out.
So, Hank, they say about risk that it never goes away, it just goes to a different place. Is that true of leverage as well? Is there less leverage overall, or did it just move to someplace different? For example, from private to public balance?
Well, there's no doubt that we have more leverage now. At the government level. There's no doubt about it. So if we were to have another financial crisis, and you'd say, what are the ways where we're worse off? Because first of all, I agree with what Sheila says, that the financial system is less levered, banking system in particular, less levered. The regulatory structure is better. There's more oversight. We have some protections now we didn't have then. I am more concerned than Sheila is about a couple of the things that were taken away. You know, the ability to use the exchange stabilization fund to guarantee the money markets. I think one of the most powerful things we did was what Sheila did with, you know, the FDIC guaranteeing. You know, it should be a very, very high bar to use it, but it was a big part of stopping the panic was guaranteeing. You know, the bank debt, you know, new bank debt, but as I look at the overall fiscal situation, there's yet less room for governments around the world, right, to use fiscal stimulus, and with interest rates as low as there are, there's less room to lower rates, and so we don't have the typical Keynesian toolkits. And you know, and I'm you know, concerned. It's not ideal, but we still have a balkanized regulatory system. We still have, you know, it's not an ideal regulatory system. It's hard to justify having, you know, a regulator for the futures market and a regulator for the cash markets. And so it's not perfect, but there's been some real improvement, and I think the financial system is safer.
So looking back on it now, what didn't you get done, Hank, that you wish you could have gotten done?
Wow, you know, so I would say this, that first of all, you need to understand what we're working with. So the regulatory system had not kept up with the modern financial system, right? You know, after the Great Depression, you put in a regulatory system and authorities to prevent bank runs. And, you know, when Sheila and I were there, more than half the credit was flowing outside the banking system. And so we didn't have the authorities we needed. In terms of, we did plenty of objectionable things that we found very objectionable. The only problem is they're better than the alternative. and so that's what you're doing with a crisis. So I look at it, and I would just cite, so the biggest, you know, I look at it, and the biggest mistakes that I was part of, we corrected immediately. So the idea of saying we weren't going to put capital in banks, we were going to buy illiquid assets. And the situation changed, the facts changed. And when I went to President Bush and said, guess what, we're going to have to put in capital, he said, well, you told the whole world. And I said, what are you going to say? I say, we made a mistake, you know? And it was a fortunate mistake, because if I thought we're going to put in capital, I would have been transparent, and the Republicans would have had a hard time voting for it. I would say with Fannie and Freddie, we asked for expansion, really expansive authorities. And I thought that if we got unspecified, you know, asked for really unlimited, I said unspecified, that I hoped that would satisfy the markets. And it didn't. But when the situation changed, we put them into conservatorship. I wish that they weren't still in conservatorship, but don't have a lot of regret about not getting that done. That was not the time to do that. That's a job for Congress. But
So one of the challenges, Sheila, you and Hank had was the difficulty of orderly liquidation authority. Is that what you call it? Basically the equivalent of bankruptcy with these big financial institutions. Did you get that fixed? Is that a lot better now?
Yeah, I think it was, the tools are there now. It was going to require a lot of political will to use the tools, but the tools are there. They weren't there before. One thing I tried to get as a companion to that was the ability to make an assessment on large financial institutions to provide working capital for a fund to support that resolution. We got that in the House. We didn't get it through the Senate. I think that would have been a helpful tool, again, just to have that extra buffer protection against taxpayer support, but also we would have based those assessments on risk too. So that would have given us another economic incentive, you know, to penalize institutions that were highly leveraged or heavily reliant on short-term funding, had a lot of non-transparent assets on their books, things like that, typical accepted indicators of risk. So I would have liked that, but I do think we pretty much got the tools we needed. You're right. I mean, and Hank, there's some tools that the Congress took back. Like they did one thing I agree with. They did. I actually pushed for it. Was they took away the Fed used something called 13.3 lending authority, which had hardly ever been used before throughout the history of the Fed. And this basically allowed them to lend to non-bank institutions. And so they use that significantly, trillions of dollars of credit facilities, but Congress said, well, we don't want you doing one-off bailouts with that because now we have Title II. And if we have a poorly managed institution, we want to go into Title II. So we're going to preserve your authority to make generally available assistance through 13.3 if you have a truly, system-wide crisis. I actually agree with that because I think if you'd preserve the 13.3 one-off authority, banks would still be assuming, or others, or Dick Fool types would be assuming, I'm going to get a bailout, so I'm going to hold out, and I've told Hank, on Title II, I think if we'd had Title II with Lehman Brothers, we wouldn't have had a Lehman Brothers failure, because I think Dick Fold would have looked at Title II and said, well, gee, under this law, my shareholders and creditors are going to get wiped out, and I'm going to lose my job, and I'm going to get 3 years of my pay called back. I mean, it's quite punitive. So I do think that is an important tool. I think it was appropriate to take away 13.3. It is somewhat curious that they took away the ESF and the FDIC guarantee, because those were, I think, two of the more effective programs that you could quickly put on and then quickly take off. I mean, unlike Fed lending, which has a very long tail, those are basically guarantees, one for money market funds, one for financial institution liabilities, which you could put on and take off very quickly. Didn't add to the money supply. They were framed to basically just protect what was already in those accounts. And so it's curious that they picked those, but anyway, it is what it is.
But and the interesting thing about this, the worst kind of financial crisis is a panic. The panic when investors lose faith in all forms of credit. They flee to the safest, Treasury bills, liquid assets, risky assets, prices collapse, and new credit dries up, and it's a disaster. And what I saw was the market. There's something about a guarantee that is just so clear. And the other thing about a guarantee is the public doesn't have the visceral reaction against it. It just does not have the visceral reaction. So the public wasn't angry about the guarantee.
No, they weren't. No.
And they weren't angry about the Exchange Stabilization Fund. But putting capital, I think one of the more effective things, combining the capital program, the TARP capital program, with the FDIC guarantee, we went out, we put capital into 700 banks, and we did it with lightning speed, and the money came back with a profit, and I think it did a big job in stopping the panic. But the public hated it, and they absolutely hated it for two reasons. First of all, it's a red line putting, we in this country putting capital into any private institution, public taxpayer capital is terrible in the public's mind, number one. And number two, they saw us as aiding the arsonists, right? And so the bankers, and we did not put tough restrictions on compensation. And the reason we didn't was we couldn't force all these banks to take capital. And we, in a crisis, in a panic, the crisis can spread, and the system is so fragile from relatively weak banks to relatively strong banks. And if we put tough compensation restrictions, it would smack of nationalization. They wouldn't have taken it. So what we did was we did something that let us be successful, but was very unpopular. Meanwhile, the guarantee, the guarantees, all the money came back with a profit, and you managed those flawlessly.
But at the same time, it was wildly unpopular, as you say. It goes back to something Sheila talked about with respect to OLA, which is wildly unpopular. Is that to reduce the possibility in the future crisis? Because there will be some crisis we face of having the political will to really move forward, because congressmen, senators, maybe presidents are going to say, look, I don't want to go that path again. Yeah,
so I think we don't know how it's all going to play out, but I do think with Title II, look, I support regulation and supervision, but I think you need market discipline as part to complement that. And I think Title II provides some accountability. People say Dodd-Frank codified too big to fail. It's just the opposite with Title II. It was designed to end too big to fail, to provide a framework that could work, that could manage the failure of these institutions, that would continue their functions to support the real economy. All right. So and this is true in a bankruptcy too. So when a mismanaged institution fails, you want to impose losses on shareholders and their creditors. I mean, they took risks. They maybe didn't do their homework. They bought the equity. They bought the debt. Whatever. That's what you take the risk of your investment. But on the asset side, you want that small business to continue to be able to access their credit line to make payroll, or the family going to their home, their mortgage closing, the funding being there for their mortgage. I mean, to the customers, that's the kind of activity you want to keep going. You want the ATMs open, you want access to the insured deposits, all of that. So this is basically what Title II gives the government to impose the accountability on the liability holders while continuing the services to the economy that avoids that disruption. And I do think it can work. It's been used, albeit for smaller banks, but it's been a lot of good work with the Fed in terms of planning for this type of resolution. And I think it can work and would impose accountability and would give a more politically palatable choice to the government. I hope that this doesn't happen again. I think our first priority should always be to prevent it from happening, so all of this is hypothetical. But if it does happen again, to have some tools that will impose accountability, which I think is really what the public wanted. And I get why they were unhappy. I was unhappy too, that we had, as Hank said, we did some things that none of us really liked doing. But I do think the tools are better this time, and hopefully the political will be there to use them. And then Congress will support the regulators in using them.
I would just add, I'm not going to debate Sheila because I agree with 90% of what she said. But I would say that if we were to have another epic crisis, I think at the end of the day, the congressional intent with the Title II, with OLA, is that this can be done without government money. That's sort of the intent by and large. But I think to start, if you had another epic crisis and you had multiple failures at one time, I haven't studied this as carefully. Sheila was there when this was negotiated. She played a big role, which I applaud, in working with. I left at the end of, I left on January 19th or 20th, 2009. Sheila was there through the crisis, and she was there through Dodd-Frank. But it's going to take real political will, because my own belief is that there's no bank that is too big to liquidate. But during a crisis, any bank of two sizes is too big to liquidate quickly without damaging the economy. And if we had multiple failures, the tools are going to have to be used. It's going to take some real political will to use the tools. And my own belief was, I was really glad at the end we had the fiscal authorities from Congress. We went to them, we got them. It was costly, the time it took to get them. I mean, we could not have got them a day earlier. Even in the darkest days, after the Lehman failure and so on, the House voted down the TARP the first time. And so I do think it takes fiscal authorities. I think a guarantee is very useful. I wish we had, Title II, and I'm glad we got it going forward. And I also agree with Sheila, the danger of going the other way. Moral hazard, if anybody thinks regulation's ever going to solve the whole thing, they got another. These bankers weren't trying to blow themselves up. They didn't find the risk themselves. It's hard to believe the regulators would have found all the risk. And what moral hazard is about is having every counterparty, every lender, every investor having skin in the game and looking at it. And that's the point that Sheila's making, and I agree with it. I'm just maybe still, even though it was 10 years ago, suffering from recency. And I will tell you, when there's a big panic, it takes a real forceful action and government money, and that I don't think is what the congressional intent is of all LA.
Yeah, well, I think I don't disagree with that. I think the assumption was that we'd probably have a triage if you had a very major event, that there would be system-wide support, which is why that was preserved on 13.3. But I think we don't need to name names, but I think we can agree that there were certain institutions that were managed less well than others going into the crisis, and the really sick ones would go into a Title II restructuring process, which would also help the economic recovery. So I don't think we're saying anything inconsistent, but I think the fact that that tool is there and the government signals that it's willing to use that tool will in and of itself have a disciplining impact on those who may be thinking about taking some imprudent risks right now and hopefully making them think a little longer term.
So let's talk about the next epic crisis, to use your term, because there will be one at some point, just the way history works. There is a lot of capital that's been put into institutions that were not literally as large or maybe didn't exist 10 years ago. I mean, if you just look at the capital right now of BlackRock, for example, of Berkshire Hathaway, of these huge institutions that are not banks. Does that pose a potential risk? I mean, it's not the same kind of risk. You don't have deposits. It's not a run on the bank in a traditional sense. But if a lot of capital has been put into these assets, and the assets may be inflated, they turn south, what could that mean for the system?
Well, it's a good question, I think, and they're not just their traditional business; they're playing a bigger role in credit intermediation now too. And so, whether that, but they don't, insured deposits are a stable source of funding. We actually saw deposits running into banks during the crisis, not the other way around. So the more credit functions go to that non-bank sector, the more you have to worry about what happens in a downturn when market sources dry up. So I think it's a good question. I don't think we have a good answer. I think if there was one thing that, Dodd-Frank, there are a couple gaps there. One was housing finance. We still have Fannie and Freddie conservatorship. I don't know. The way we finance mortgages here and the government's role is kind of crazy. And then for non-bank regulation, they did set up something called Title I, which really they've been very reluctant to use, which would allow you to designate a BlackRock type institution for prudential regulation by the Fed. Understandably, there's reluctance to use that if there's no sign of problems. Why? Because it's a big deal to be regulated by the Fed. So how that works, I don't know. I will say that just in terms of the extent their exposure is more to financial assets, because of the good news and the bad news about income and wealth inequality, the exposure to their market losses would be more because upper income and rich people tend to own more of the financial assets. They're more resilient, so if you have losses, the economic impact would be less severe than a housing-driven crisis where everybody was pretty much using their homes to help support consumer spending.
But is that entirely true? Because you have big pension plans, big institutions investing in these, and you also increasingly have a BlackRock. I don't mean to pick on BlackRock, but it's true. With attracting retail investments in some of the ETFs and some of the passive investments.
So I think that even about half the population, they don't have any exposure to the stock market. And I'm not saying it wouldn't hurt. It would hurt big time. And these pensions in particular are underfunded already based on some very optimistic assumptions about returns that probably are not going to play out. So no, it would hurt. My only caveat is that the economic impact, the real economy might not be as severe because those fluctuations in the values of those assets do not drive consumer spending the way home values drove consumer spending in 2008.
Hank?
Yeah, I would just make one simple point, and Sheila made it and passed over it quickly. But it's not perfect, but there's the FSOC, at Treasury, which it does have the authority. You've got a committee that can look anywhere in the economy, and if they see a systemic risk, they've got authority to deal with it. And that was, it's not perfect, but that's more than we had. And,
that's true.
And so that is a positive. But I think the thing, you're asking the right questions, because the question I'm asking is not just now, but as we look forward. And, because if we find the economy or the financial system continues to develop, so big parts of it escape regulatory oversight. And if we regulate the banks so heavily that we drive the risk in other places where we can, and there's plenty. You keep citing one or two institutions. I can think of plenty of institutions, that oil trading concerns and so on around the world. There's plenty. So what you need is you want oversight and you want the authority to deal with it. Because my own view is that the financial system is going to continue to change significantly. But there are certain things that are going to be true. As long as there's human nature, and as long as there's runnable assets, we're going to be subject to panic. So you're going to need some oversight, some authority, and you're going to want some capital cushion. But I don't spend a lot of time speculating about where the next financial crisis is going to come from, because I think these things are pretty difficult to see, aren't they? They're unpredictable. And so, but you really do want to have a regulatory system that is one that can continue to change and reinvent itself as the financial markets change. But I'm not going to sleep at night worrying about insurance companies. I'm not sitting there saying, "Gee, I think something is going to happen at Berkshire Hathaway." If I were looking for risks, I'd be looking outside the U.S. and so on. And the world is becoming smaller and smaller and more interrelated and so on.
Well, in your book, Hank, you said when you went into the Treasury Department, you thought there were imbalances in the system. You didn't identify mortgages as being where it would show up, but you thought we were getting ready for a financial crisis. Do you see big global imbalances right now that at least you'd be looking at, saying we should watch that carefully?
So when I went in, the very first meeting I had with the economic team and President Bush, where he had asked that I talk about entitlements, because that was one of the reasons I'd come to Washington. I said I wanted to talk about excesses I thought were due for a financial crisis. But I was talking about something like the ones I'd been through before, which to everybody else was just a little bit of disruption. To me, at the firm I was running, that was a big deal. But I saw excesses like I don't see today. I mean, I looked at when I looked at the embedded leverage, and I looked at the various bubbles, and I saw all sorts of money looking for yield and mispricing risk all around the world, and big capital flows coming from Asia, and from Germany into the U.S. So I saw a different kind, but I'm very humble about the fact that I didn't. When I looked at the mortgage market, I said there are problems there, but I was a creature of my upbringing. I'm born in 1946. There hadn't been a nationwide decline in residential home prices. As a banker, I looked at residential mortgage diversified portfolios. I said the risk is not that I'm not going to get the money back, I'm going to get it back too soon. Interest rates are going to drop, people are going to prepay, and so I missed it. So I just think it's much safer to say that we need to be very vigilant, and we need to be humble enough to know these aren't predictable, and and just make sure we've got the right regulatory system.
So Sheila, what about you? Where would you be vigilant today, particularly vigilant? I mean, you mentioned consumer credit.
Yeah, so I mean, that's high. I'm a traditional Republican. I worry about the government debt, which is at historic highs and climbing. It's on a very unsustainable trajectory. Corporate debt is extremely high. Leverage lending is the standards have loosened there significantly for several years now. Non-mortgage consumer debt is at historic highs, all expressed as a percentage of GDP, and even mortgage debt starting to tick up a bit, and you're seeing some deterioration of lending standards. I think, subprime auto has been a problem for years. It makes me very uncomfortable. I think there was an assumption during the crisis. We observed a new dynamic, which was people stopped paying their mortgage but continued making their car payments. And when the foreclosures just seized up, people figured out, we cannot pay, it's going to be a long time before that bank can get my house back, so I'm going to pay my car payment because I need to have my car for work. So I think the lenders said, well, car financing's so safe. But the problem is they're buying multiple cars now, and they only need one to get to work, if they, and then the deterioration value obviously is very, very quick. I think there are probably going to be some ugly surprises in that sector. And again, you're always going to have, though, credit losses in a downturn. It just happens. Again, I hate to sound like a Johnny One Note, but that's why you want a resilient system and a well-capitalized system when that downturn comes. But just the debt overhang generally pretty much in all categories except mortgage debt right now is at historic highs. So this effort to deregulate now in Washington because we need banks to lend more to support the economy. I don't buy that. They're lending enough. Maybe one of them lending a little less at this point.
Well, Hank, what about, we mentioned sovereign debt before. U.S. sovereign debt is really climbing. We're borrowing a lot of money. Goldman Sachs, as I recall, has something to do with bonds. You trade in bonds occasionally, know something about that. At what point is the bond market going to pay attention to how much we're borrowing? Because right now, we're borrowing record amounts, and they can't sell them fast enough. I mean, people want to buy them right away.
Yeah, I'm not focused on as much on the bond market and risk there. I'm focused on the United States of America because Sheila said something else. She's very wise. She said something. She worries about the resilience and competitiveness of our economy. And I'm looking at it and saying, at the end of the day, we're going to have financial crises. And the best we can do is hope that we've got to keep our economic competitiveness, our economic strength, will be resilient. And you take a look at the most predictable, one of the most predictable economic issues or problems, I guess it's a crisis, is the fiscal debt. So and what does that do? That squeezes out our ability to invest in our future. And that we're ultimately going to fix it. And the longer we wait, the more painful it'll be. So I'm concerned about that. And as Sheila mentioned, consumer debt. I look at it and say, why should we be surprised? We incentivize borrowing. We make it easier. Interest is tax deductible. We penalize savings. Why do we consume more than when we produce as a nation? And so we've got some perverse long-term incentives. And one of the other very perverse issues we've got is the one thing we both were focused on was income disparity and the people that are being left behind and not participating. And this predated the crisis. I mean, this was a contributing factor. Why was household debt doubling in the 10 years, in the excess years? Because people were struggling to make ends meet. And so to me, the most important thing, I'm more focused I'm not as focused on regulation. I'm much more focused on, let's take this period of strength and let's do the things we need to do to fix our problems. We've got the strongest, most diverse economy in the world with the least problems. But now's the time to fix the ones that are going to really undermine our resilience.
So Sheila, I see you're nodding your head, but I mean, you're not politicians, either one of you that I'm aware of, but you both know Washington well.
Right.
You talk about a perverse incentive. Let's go back to what some people might suggest a perverse incentive. If I want to get reelected, I don't care if I'm a Republican or a Democrat, I don't get reelected by saying we're going to spend less money, that we're going to tighten up here or there. Go back to Hank's entitlement challenge. There's just no political incentive. Is there any way through that?
Well, yeah, no, I joke that bipartisanship isn't dead in Washington. They can always agree on spending money we don't have, right? So it's tax cuts or budget appropriations. There's a lot of short-termism in terms of it's easy to spend money and very hard to go the other direction. But you can do it. I mean, I worked in the Senate in the 1980s. I worked for Bob Dole. We did meaningful tax reform. We closed loopholes. We did a radical reducing of marginal rates in 1986, but we closed loopholes to pay for it. It was done on a revenue-neutral basis. Got a lot of frictions out of the system. Fixed Social Security in 1983. If you have leadership, you can do it. And bipartisanship was the answer, too, because they would know we've got some tough decisions. We've got Social Security. It's getting into trouble. We got to fix it. We're going to have to make some unpleasant things. We're going to have to tax some benefits. We're going to have to, increase withholding. And this is going to be unpopular, but if we do it on a bipartisan basis, if we do it together, we'd lock arms, right? I can't make it as an issue against you, and you can't make it as an issue against me. And that's how it worked. I think it can work again, but we need leadership.
And I want to just point out something about Sheila. So she's a Bob Dole Republican, and she worked with the Democrats as well as she did the Republicans.
Oh, thank you.
The reason she was so successful, that's true. You could work with Chris Dodd, Barney Frank, and Mitch McConnell and John Boehner. And that was something I tried very hard to do, too. We both did that. But that is the key. And when I arrived in Washington, Sheila was already there. But President Bush, I just will tell you, was a great leader during the crisis, as far as I'm concerned, financial crisis. I could not have had anyone that was more supportive and stronger. But he was in the high 20s in terms of approval rating. The atmosphere was poisonous. But, he encouraged me to work with Democrats as well as Republicans, and I had client training, in investment banking, and I treated them. But I've got to tell you something. Sheila Bair was a model. And so she did things that people might have hated, and they liked it. And that's true. That's true. And there's no one, you talked about, that worked harder for homeowners. There was no one. Where the Republicans were, it was a toxic issue with Republicans to deal with foreclosures. And there's no one that worked any harder on that. So that's true.
So we're about 6 minutes away from taking questions. You can start thinking about your questions right now, all right, because we're going to come in about 6 minutes. Before that, I guess Hank and then Sheila, a question. It's been 10 years. We've got a lot of young people who've come into the workforce, who really have only known this world right now, which has been a world of tightening and increasing income disparity. What lessons are there for those young people? What do you say to those young people?
Well, first of all, those are difficult conversations because many have lost faith in our system. Many of them have got a lot of student debt, right? They're drowning in debt. They're asking themselves, as a U.S., are the best days ahead of us? Is our government lost its competitiveness? Is the federal spending, is your generation, selfishness going to drown out our future? So they're asking all that. But one thing I say, which is sometimes not, when they ask me about the crisis, and I had a conversation the other day with someone, they said, what should I know? And I said, well, first of all, you should know your government let you down because the regulatory system didn't change when the financial markets changed, number one. Number two, as bad as it was, and it could have been much, much worse. You'll never know, but we were close to, and the thing I need to say to you is that finance is our lifeblood. Finance is the key to our economic competitiveness and your economic security. And you owe it to yourself to be financially literate. And I can't believe the number of really smart young people that aren't financially literate. And for whatever reason, people got themselves in trouble. And I'm not casting blame or whatever by taking on too much debt. So the biggest thing I say to them today is please, please, please learn everything you can about finance. And whenever you take on debt, don't just listen to the salesman. You read the fine print. If you don't understand what you're signing, don't sign it. And please, when it comes to your savings or your investment, try to understand that and try to save. It'd be nice to save and rather than just spend. But it's you spend a lot of time. You've done a lot with financial literacy and with young people and a college president. So what do you say to them?
Well, I tell them the same thing, but I agree with you. I think they've so it's shaken their faith in capitalism, number one. And also just debt, we're awash in debt and government debt. I think increasingly millennials in particular are thinking, well, it just doesn't matter. We can just always borrow. And that's not true. I mean, the thing about debt is eventually you do have to repay it. You have to repay it or refinance it, and interest rates can go up. You're exposed. We heavily rely on foreign investment to buy our debt, so we can't control that. So even though we can borrow a lot of money today, that doesn't mean 5 or 10 years from now we can. And as Hank says, those growing interest payments crowd out so much other investment that we need in education and job training and in infrastructure and things that support our economic prosperity. So I do think it's skewed their perceptions in ways, that it's made them very skeptical of capitalism. which is why, again, why I believe in markets and I believe in capitalism. I think you need regulation around it, but making sure if we have another crisis, there's some accountability there that the public can see, I think is going to be very important. Because right now, unfortunately, I think a lot of these young people identify capitalism with political influence and what I call crony capitalism, and I think that's unfortunate because that's not really how it works, should work, or needs to work. But yeah, it's sad. We have so burdened their economic future, not just on government debt, but now the shift to student debt, to heavy reliance on student debt to pay to higher education. All of this is going to weigh on them, and my generation needs to do more to acknowledge our responsibility and giving them these huge bills to pay, and starting to work now to whittle it down so that when they get my age, that they're they can face a prosperous retirement and a healthy Social Security system, just the way hopefully I can now.
Okay, we want to open up to questions now. I have some also online. So what we'd like to do is try to keep it to the subject, the financial crisis, the aftermath, where we are now, something around that neighborhood if we could, and try to make it a question if you could rather than a speech. We'd prefer it. Try to keep it reasonably succinct. So we'll start here and then we'll go back there, and I also have some online, please. I guess there's a microphone coming up.
My question is for either or both of you. In the aftermath of the 2008 financial crisis, were any of your fixed beliefs shaken or changed about the government, regulation, the economy, human nature?
You want me to go first?
Yeah, you go first.
Okay.
It's all yours.
Okay, they were, because it's an interesting thing that you ask, because they were shaken in a couple ways. Because when I was in the private sector, it bothered me when I saw politicians or state attorney generals pushing around companies, for what I thought were political purposes and being heavy-handed. Okay, it bothered me. And so I found myself, it was just stunning when I found myself, some of the things I found, taking over companies, nationalizing them, pressing companies to merge, and doing the sorts of things we did. And I think it was for entirely the right reason. But it was objectionable, but we had to do it. I never, ever would have thought myself as being someone who was going to be the architect of rescues, or what people would call bailouts. I believe in markets, right? And how are markets supposed to work? They're supposed to reward success. They're supposed to punish excesses or failure. If Americans don't care if they make an investment and someone gets a profit, but if they take risk and then the taxpayer pays, that's not something you want to do. But we did things that, I remember explaining to people that, and House Republicans that said, how can you do this? Don't you believe in markets? I said, yeah, I believe in the American people. I believe in markets. But if I don't do this, we're not going to have any markets left to believe in. And so it's clear to me, and Sheila said it very rare. She said, I believe in markets, but I believe in good regulation, right? And authority. And we got ourselves in problems where we had to do things that we would rather not have done, because we had markets that had developed outside of our oversight, outside of we didn't have the transparency, we didn't have the authorities to deal with it. So we did some things that were objectionable. And in terms of human behavior, I think that the crisis exposed some of the very, very worst things that you could ever see in terms of greed and things like that. But at the end, I left grateful for what I saw, because I saw Republicans and Democrats coming together twice, doing, twice we got, bipartisan action, to really save the country. We got great policy continuity. I got to work with people like Sheila, and the people we worked together. The bonds that were formed, in terms of working like we did to try to put out that fire, were significant. But yeah, you couldn't go through that without changing your view. I've given you time to think about it.
Yeah, I know. Sure, no. I'm thinking. I'm just going to say ditto here. I agree with that. I think I never in my life, and I was very early on subprime mortgages. I mean, this goes back to 2001, 2002, when the Treasury for me. I was raising my hand early on that. I never thought it would spin out as far as it did, and as badly as it did, and that we would have to take the extraordinary measures that we did. But we did. And we all worked together, and we had disagreements, but at the end of the day, we always, and that was due to Hank's leadership. He was the person convening meetings at Treasury and knocking heads and getting us all to go along, and we did. We moved forward. One thing that did bother me, and this actually happened after Hank left, but it did astonish me. I think people tend to talk about Wall Street like one big blob, and Wall Street is a complex ecosystem, and there are different players.
Paying the bonuses they pay.
Yeah, okay, that's where I was going.
That disgusted me too.
Yeah,
disgusted me.
I couldn't believe it. I could not believe it. They came in, they pressed us, and now they had the TARP, and that got through, and they wanted to pay the TARP back because they wanted to get rid of those, because there were some compensation restrictions that went on with those that had gotten double dippings, double helpings. So I was disgusted with them. I was just absolutely disgusted.
Yeah, I thought it was an interesting thing, but I thought the whole financial system benefited. By every one of those banks did. And when the government did what they did, to then go and pay those bonuses, it was a total, it was just so egregious. And it was, so that was, and I got to tell you, I spent a career on Wall Street, and that shocked me. So it did.
So we're going to go back to a question back there, but first I'm going to sneak in one, sorry, from online, because it relates exactly what we're talking about here. What it says is, what do you think of the common critique, I'll direct it to you, Sheila, of the financial crisis response that more people should have gone to jail? Now, whether there's the criminal question.
You're all supposed to start clapping. That's what always happens when someone asks that question.
But there's the jail question, the criminal question.
Right.
But even broaden it out a little bit, did moral hazard really apply to all the executives? Because even if they didn't go to jail, there's a perception at least a lot of them walked away with a lot of money and left behind a lot of disaster.
Yeah. Well, I think that's spot on. I think people focus on criminal liability. I think a lot of this was just recklessness of mismanagement. I don't know if it was criminal, but there certainly should have been much more monetary damage to people's personal pocketbooks, not just the shareholders of the financial institution. We didn't go that route, so there were huge settlements, but they were all paid by virtually all paid by corporations. And there are a few. I won't mention names. There are certainly a few at the top of my list that I think probably should have been in jail by looks. There were some really toxic subprime mortgage operations that you just couldn't believe it when you got in there and saw what was going on, that the top management didn't know that there was fraud going on. But I think mostly, for the large financial institution, it was short-sightedness. It was not paying attention. It wasn't a criminal problem, but not a joke, because so poverty can sometimes, with folks in this industry, poverty can be more effective than jail. So maybe there should have been more financial penalties, but jail time maybe not so much.
You want it, or we can go back there?
I just was to say I wasn't privy to I was surprised that there weren't more that went to jail, but I wasn't privy to the evidence. I think what Sheila point was right. You can do things that are wrong that aren't necessarily illegal. And I would say also that when we nationalize institutions like with AIG and Fannie or Freddie, the shareholders were greatly diluted. The managements were changed. They lost their parachutes. I'm not sure moral hazard was. I don't know any of these CEOs that was trying to blow up their company or wanted these bad things to happen. But there's no doubt that the part of the issue we had and why what we did was so unpopular is after the Great Depression, the institutions had failed. If the institutions have failed, if you let this thing burn and they collapse, then it's disastrous for the country, but it's easier politically. And I think part of the reason people were as angry as they were is we were trying to stabilize and prevent the collapse. And so some of the things we did were unpopular. But in terms of, whenever I speak this anywhere and that question gets asked, everybody starts clapping. And so you know what the public wanted to see.
So you've been very patient, way back in the back.
I'd just like to come back to 2004 to April when SEC repealed the so-called national capital rule, nominal capital rule, and the impact of that on 5 largest broker-dealers, effectively increasing their leverage and allowing them to move into the most scalable product, which was MBS at that time, and subprime MBS. And kind of segueing to 2008, as we saw the TARP initial round did not stabilize the markets because there was not buying any troubled assets. It was obfuscating the
question,
with Goldman. So was the whole bailout done to effectively help out Goldman, Morgan Stanley, the Pew Boys, and effectively the only public-private investment partnerships in March of 2009.
Okay, I think we got the thrust of it. Thank you very much. That's great. Hank, I think that's for you. Was the whole bailout for Goldman Sachs?
So a couple of things. First of all, on the leverage. The broker-dealers had much higher leverage than the banks. The broker-dealers had different accounting. So if you adjusted for the mark-to-market accounting, well, the banks had historical accounting. So banks had assets on their books sometimes at 100 cents, 95 cents on the dollar, where broker-dealers marked them to 50 or 60 cents. The thing that I focused on when I ran a broker-dealer was on liquidity. And because capital and markets can change. And when I left Goldman Sachs, there was $60 billion of unencumbered treasuries in a lockbox for liquidity. And, and I watched some of the broker dealers that had virtually no liquidity. Now, in terms of the rescues or the bailouts, we put there was a severe panic in the marketplace, and so we asked all sorts of banks, ones that were shaky or ones that weren't as shaky, to take capital. That after Lehman went, there was a huge focus on Morgan Stanley, which had liquidity going faster, and on Goldman Sachs. And what the two of those banks were able to do, Goldman Sachs through getting a big equity investment, a cornerstone investment from Warren Buffett, and Morgan Stanley from Mitsubishi made a big difference, and then the TARP capital. But very quickly, I think part of the reason that the things we did were so unpopular, it's just evidenced by your question. There are just a lot of people that feel that way. And I can just say to you that what we had to deal with and what the regulators were trying to deal with was if we waited till these firms collapsed. I mean, you look what happened when Lehman went down. If you waited until they collapsed, I don't think we could have put the system back together again. I sat there, I had a couple nights where I literally woke up in the middle of the night and just looked into the abyss and said, if we have another institution or two go down, what does this mean for America? I was looking at food lines. I was looking at just massive unemployment. And so, but if we'd waited till they went down, then you wouldn't be giving them capital. But what I think we had to do was the system was so interconnected, we had to go to the source. And the way I look at it, the source was, so you had to go to Wall Street, which was the source. and that if we'd waited until there had been a collapse there, I'll tell you, it would have been a big problem. And so it's sort of the lifeblood of the finance system. And the TARP was like the tourniquet. But that's what we did. And your question, I think expresses a view that many people still have, and that it was unfair, and the arsonist got rewarded.
Okay, another one from the audience. Boy, we got a bunch of choices. How about just right here? Could we, in the middle? Microphone down here, could we please? Thank you very much, man in the blue shirt.
Thank you. First of all, thank you for coming to Chicago for the council. You both made reference to political will several times, and you worked with President Bush and President Obama. I'd be curious your perceptions if it fell in the current Trump White House, what you perceive.
Oh, I think that's for you, Sheila.
Well, I'm at least on financial regulation. I think our political will is going the opposite direction. I joke that we're regulating to the political cycle, not the economic cycle, because there's a good deregulatory move now, even in the area of financial reform, which astonished me. Certainly in other areas I expected it, and some of it I'm supportive of. But yeah, we've got to push to weaken the capital rules. The stress test requirements have been eased somewhat. There are proposals to ease them more. And Mr. Trump said, he was going to do a big number on Dodd-Frank. He's publicly not been a fan of the law. It's not perfect, but it's, he gave the basic tools and provisions that we needed. So I'm very worried about it. And it's just, regulatory system, people ask me are we ready for next crisis? And I said, well, we best, because Washington's starting to deregulate, because that's what happened in 2006. You get towards the end of a cycle, people are making money, everybody's happy, banks aren't going to fail anymore, banks don't have to manage risk, everything's fine, let them lever up, let them take risk. And really, at the end of a cycle, you should be doing just the opposite. You should be tightening regulation a bit. There's something called the countercyclical capital buffer that a lot of people are trying to encourage the Fed to impose now, which is designed to do just that, to be countercyclical. So at the end of an economic cycle, when asset valuations get up and people are looking for yield and lending standards are loosening, to have additional capital required on them, not loosening up, which just reinforces where we are in this cycle. So I do worry about it, and I think, this administration, like any administration, needs to think longer term, and we want a banking system that can function in good times and bad, not just in good times. And, with all the debts out there already, to say we need to let banks, take on more leverage so they can lend more, I'm not sure I understand that. The economy's pretty strong right now. It's hard to make the case that the banks need to loosen regulation to help the economy.
But the reason Sheila and I are doing this is not because we want to go back and relive this. It's because I still get the heebie-jeebies. Just I'll probably be thinking about it again tonight after doing this. But the enemy is forgetting. Yeah. Yeah. That really is the enemy. The lesson is to not forget. And I would say, so I don't like the rhetoric. But I would say I do like the appointments to the Fed, and. And I think by and large, although the rhetoric is going one way, there hasn't, at least I'm not as close to it, I'm not in Washington today like Sheila, but I think we've still got, we've got what we need, and banks are well capitalized. I just don't want to forget and go too far.
Okay, one more question I think we have time for, because we're coming down to the end here. What about just right here, because your hand up before? Gentleman right down here, fifth row.
So thank you very much, both of you, for your service during that time. As a man who ran a business during 2008, I appreciate your logic and pragmatism in the face of doing things that you didn't want to do. The Dodd-Frank has a 5% holdback on origination for basically for securitization. My question is, would that 5% holdback rule would that have played a good incentive role in the origination of mortgages for all the bad actors that we're at the beginning of the stream of this problem. Would that have helped in the sense of analysts catching a contingent liability growing on a balance sheet that might be in danger?
You might want to just make sure everyone understands what that 5%
so I think what
is.
it was colloquially called risk retention. So the problem with securitization, this is my view, I think a lot of people view it this way, and the reason for this was that securitization severed the decision to make a mortgage from the risk of that mortgage was not going to be repaying. So the originators would typically, they had got warehouse funding from a big bank, be sold into securitization trust, be packaged in securities, sold off to investors. Investors would take the risk that the mortgages wouldn't repay. Rating agencies were giving these securitizations very high ratings for reasons that we'll never know. And but the decision to lend was severed from the responsibility of taking the losses. So you got a lot of unaffordable lending, not surprised. So the idea of a risk retention was the securitizer, the entity that was putting these into pools and selling them off, had to retain 5% of the risk. So every dollar that an investor lost, 5 cents of that was going to go to the securitizer. That was the idea, and I liked it, and I think it could have worked and could have helped. But talk about political will, then this happened after I left. The regulators did not have the political will to implement that. They got a huge pushback from the securitization industry. And so they basically, there are very few mortgage securitizations where that 5% applies. But I do think it was more of an elegant way to put, again, more market discipline into the lending decision, because now we're trying to do it all by prescriptive lending standards that go, here's an affordable loan, here's not an affordable loan. So it's kind of government deciding what's affordable and not. Having a nice skin in the game requirement could have forced better decision making on the part of the originator, but they didn't have the political will to go forward with it.
What about, Hank, have we put the responsibility together with the decision making for people issuing loans?
There's no doubt that Sheila knows as much about the mortgage and securitization process and all the problems of trying to deal with mortgage restructurings and workouts, and because the servicers, the whole servicing network was so bad. Yeah, we just, the fact was, it used to be, when you made a mortgage, if there was a problem, you could go talk to your banker, and if there was a reasonable way to work out, you could. And so it was without a doubt the most complicated situation I'd ever seen trying to work on minimizing foreclosures. By far, the most important thing we did was nationalizing Fannie and Freddie, putting them in conservatorship. Can you imagine? They were the only, for all primary purposes, the only source of mortgage funding during the crisis. Can you imagine if we didn't have mortgage financing, how much farther home prices would have dropped and how many more foreclosures there would have been? But it was really it was like a Rubik's Cube to try to solve this thing. And you're right, if people don't have skin in the game, how can you expect them to do the kind of risk analysis? And the legal system at the end of the day didn't hold them accountable.
Exactly right. Okay, first of all, thank you all very much. Sadly, we're running out of time because there are a lot more questions here online for all of you, but thank you all very much for your attention, and mainly thank you to Sheila and thank you to Hank. That was terrific.
Thank you.
Thank you.
Nice job.